Hello, this would be our fourth session on loan syndication business line. And I'm sure you would have, if you have gone through my, let's say, previous videos, I'm sure you would have enjoyed that as well because each and every video would be linked with each other. Don't worry about it. If you haven't watched, then what I'll do, I'll provide you all that previous session in that description means video description. You just need to check and click on that link. That's all right. So in this session we are going to cover the main important aspect, because while dealing with, let's say, if you're a part of reconciliation, recon what happened if you're a part of, let's say, banded product or maybe loan syndication. If you are a part of loan syndication, then you will have to deal with transactions like pay down, right? Transactions like pay down. See, I'm going to discuss very much practical examples, so don't worry about it. At the end, I'll help you how you can relate that pay down or other technical terms in your current job as well. All right. So you would you would see transaction types like pay down. How you can resolve pay down breaks if you have anything as such. Or maybe let's say pay down, it means what it is. What is pay down? Pay down. See, pay down, it means it's a repayment of principal amount to the lender. So it means if you are a borrower, let's say, and you have decided, you have taken loan, assume it, you have taken loan of 10,000 for a 10 months, but you have committed to that particular company that you will make a payment of principal, let's say 1,000 every month along with the interest payment. See, interest payment, that becomes a different portion, which is interest payment part. But when you actually return principal amount of total outstanding loan, then that portion becomes the pay down. Portion becomes the pay down. So let's see this. I'll explain that with example as well, how pay down works and all. Alright, so pay down, it means, as I said, it's a return of capital or it's a return of loan amount. Return of loan amount. When borrower initiate or when borrower make a payment of principal amount to reduce the principal liability, so that portion you can call it as a pay down amount. So in interview process, you maybe expect question around like why company opt for a pay down facility, right? I'll explain that. Let's say you have a home loan amount. You have taken a home loan amount of 10 lakhs for 20 years. Let's say company is paying you only, you're paying, let's say not you, you're paying, let's say, interest payment to the company, right? You're paying only interest payment to the company for next 20 years. Just think about it. Let's calculate the interest payment. Let's say 10% interest payment you're paying on 10 lakhs amount every year. You are not paying any principal amount to the company or let's say bank for that matter. So at the end of the, let's say, maturity, I am sure that you would be in a huge loss if you let's say haven't paid principal. So it means every year you are paying same interest payment amount to the that particular lender, right? And principal amount you are paying at the end of the maturity. So you already then you would be in loss. How, when you opt pay down facility, how that pay down facility help you, I'll explain that with the example as well. Just connect it there and say it. So as I said, pay down, it means it's a return of capital or return of invested amount. In a private equity, you would see word like return of capital. So it means that becomes your pay down. Actually, you will receive pay down notices, right? Pay down notices or draw down notices, you can say. So once you receive pay down notices, so it means, let's say that borrower process payment to you, all right? So that becomes pay down for you. So you have received your amount back. Or let's say you are at a borrowing side, so it means if you received any pay down notice, so it means you have returned that amount to the lender. So you would see that updated outstanding amount would be different for a next accounting period or maybe next month. All right. So let's take the example so that you can understand in a better way what is pay down it means. Let's say your fund, private equity fund, has a term loan facility amount of rupees 100k or maybe let's say 1 lakh with the interest payment of 10% for per annum, including the duration which has 12 months. All right. So I'll take you to the next to see how it works. This is your payment, let's say schedule for 2 months. I was just created for 2 months, but you can create it for 12 months to do the better practice or exercise. You can do it for your exercise if you want. Let's say in the month of January, if you see total principal was let's say 1 lakh. The interest payment ratio which we have 10% for per annum. All right. And if you see for that particular January month, interest payment would be due interest payment, or you can say payment of interest payment would be 833.33. But so pay down would be 8,333. So you might see change in this pay down ratio as well. Why? So that depends on your principal. Principal is 1 lakh. If you want to equally reduce it divided by 12, so that becomes 8,333.33. So every month you can pay principal amount of 8,333 to the banks or to the, let's say, private equity funds, or maybe let's say your lender. Why so we need to do this? When you compare this situation with the, let's say, next month, if you see, when you compare with the next month, here you would see the impact on interest payment. In first month we have paid interest payment of 8,333.33, but in a same facility for a next month or maybe month of Feb, we are going to pay only 763. So it means when you opt pay down facility, ultimately it will be impact on interest payment expenses also. All right. So this is what you can relate. Pay down, it means it's a return of principal. And why borrower will opt this facility? Because see, it's a liability, guys. When we say liability, it means ultimately we'll have to make a payment. Sooner or later we'll have to do it. If you don't do it now, then every month, let's assume it, pay down is not applied here, then situation would be different one. How? I'll explain that. Let's say that borrower, or in this particular situation, we don't have any credit facility as such. Then for a Feb month also, your amount would be same. All right. Your amount would be same. Then interest payment would be also same, because there is no pay down. So it means you would see, that you're paying highest interest payment to your lender, and this will lead to your increase in expenses also. So here the point is, when you repay the principal amount early, then you would be in profit, and if you don't, then at the end of the year you will have to pay, let's say in the month of December, you will have to pay same amount till 3 plus your principal amount. See this. So here at the end of the year, if you calculate your total interest liability, that would be something different. All right. So around 10,000 interest payment that you're going to pay. But if you reduce pay down, I'm sure your your interest liability, that would be different. You would see change in it. The reason is every month you're paying principal, so that will help you to again reduce the interest payment also. And that's what most of the companies or most of the private equity funds or even most of the institutions, borrowers or lenders, they opt this facility. And that principal reduction portion that becomes your pay down. Now I hope you would have received this, like why pay down is important and how pay down works. For example, again I'll give a simple example if you are not able to relate this so that you can understand. Pay down, if I talk about pay down, let's say I'll take now layman example. I'll quickly just explain this. Let's say you have applied for personal loan. In a personal loan, what happened? Let's say you have taken personal loan, amount is same, duration is, let's say duration is 12 months and interest payment is, let's say 10%. What happened? See the same schedule, pay down, alright, interest payment and principal. Principal, you can say outstanding amount. Every month, if it is not reducing, so it means 1 lakh would be your principal, interest payment 10%, that becomes 833 for every month, alright, and then principal pay down. If you are paying this, let's say in the month of January, if you are following this, so it means you will have to pay then in a proportionate 1 lakh divided by 12. So that would be your 8,3333. Next month, Feb, in the month of Feb, of course, we will have to minus this amount because we have already paid it. So we cannot charge interest payment on this amount. And that's what you need to go and check your personal loan account statement also. Bank then won't be able to charge interest payment on this amount, so that you can avoid or you can save your interest liability by reducing your principal. And once you reduce it, so go and check. If I just quickly calculate how it works, 1 lakh minus 8,333.33, so which we have already paid it in advance, all right. So for a next month, your liability would be this. So now you tell me, there is no change in your personal loan and home loan structure. So same pattern that you would see with the structured loans, as I said, like your loan syndication product also. We follow the same treatment. All right. And here your interest payment, then in the month of Feb, you cannot calculate interest payment on this amount. Then you will have to calculate interest payment on this amount, right? Because this is your updated principal amount, updated outstanding principal amount. So you need to pay interest payment on this amount only. So if I calculate here this interest payment, see how your interest liability, it looks like 9166.67 into 10% divided by 100, that becomes 91,000 divided by 12. See this, 763. So you would see here directly it affects on your interest payment. So this is how this schedule work. And this schedule sometime you can call it as a loan schedule or maybe your amortization schedule as well. There you might see specification, there you might see changes or maybe more customization as well. But in a generic way, if you see, you would see the same pattern or theme to calculate the interest payment and principal pay down process in your that loan syndication business. And as an accountant, let's say a reconciliation analyst, it's your responsibility to match the pay down with the amount. What happened, I'll tell you. Because we record pay downs, we record pay downs and even interest payment. In accounting system, what happened? ABOR, it means your accounting system. We record the pay down. All right. Let's say pay down amount is this, and same bank record. IBOR, it means investment books of records. So investment, in the investment books you would see like incoming wire, incoming wire of, let's say, same amount. All right, incoming wire of same amount. So it means this is becomes your ledger and this is becomes your statement. And now you need to match statement versus ledger. And if it is matched, then you can match it. So sometime you need to identify, because if let's say you have checked it, you have received your principal pay down, but that pay down is not created in your internal system like Geneva, Investran, or maybe Multiphone, right? Each and every institution, they have different accounting softwares. So in their accounting books, let's say this transaction is not recorded, then you can create that record, right? And once you create it, then you can match it off even, because matching is very important. If let's say only you have received incoming wire, when you check the transaction code, then you got to know that this incoming wire is for, let's say, PD. PD, it means pay down. Transaction code would be pay down. So this pay down, it should tie with your, let's say, recorded pay down. And if the recorded transaction is not prevail or exist, then you can create that pay down. You can create that, or maybe let's say if you are from accounting, then you can allocate that breaks to the bank debt team with the proper backups like incoming wire details and all, and then convince them, hey, look, this payment is received for pay down. So you can create that pay down transaction. Then once they create it, then of course you would be able to match it. But if you are, let's say, from bank debt team only, then you can check the pay down notice, because you have received incoming wire, then check pay down notice. Then your question would be like, where, sir, means where we get this notice? You can check the clear part, or maybe you can check your email box as well, where you will receive this pay down notice. So once you received pay down notice, then directly you can record the transactions as a pay down in your, let's say, accounting system, and update your principal. Once you update that amount and percentage, then system will calculate the net outstanding balance. Ultimately, that next outstanding balance would be eligible for a next month's interest calculation. If you don't update it, ultimately then system will calculate a wrong interest payment. So that's what you need to update pay down. If you don't update it, so that creates impact, huge impact. All right. Now I hope you got the idea about from a recon perspective as well. So how incoming wire or that whatever transaction, let's say pay down, that works in a matching or let's say accounting system also. If you're looking for a reconciliation, sessions or training, you can join our program, because we cover different types of breaks like this. Let's say pay down, commitment, buy and sell, right? Delay drawn, then cost of carry, and many more things with few, examples. It will be like simulation. If you are interested for that, or let's say if you are facing such a challenges, then you can book our private sessions. I'll provide you link in job description. So you can book and you can even learn, or whatever doubts even if you have, you can come with your doubts. Definitely will help you for that also. So yes, but I'm done with this pay down topic. I hope you got this insight how pay down works, or what is pay down and why pay down is important. I'll just summarize it. Pay down, it means it's a return of principal, capital, or let's say loan amount. So where borrower will try to reduce the debt by paying principal amount every month. All right. And again, from a lender's perspective, once the lender received their invested loan amount early, then again they'll invest in other assets and they'll multiply the returns. So it means this pay down will help to both to get the early recovery of their loan amounts, or maybe let's say from investor perspective, it will help investors to recover their invested amount. So it's a good model basically. All right. So you can check my other session as well. So I have already provided link in job description, and you can watch this session as well if you haven't. All right. So thank you. I'll take a leave now. We'll see you in next session. Thank you.